thrilled to be here with you today and like to extend my gratitude to UNITAR and the whole UNITAR team for organizing this event. Today, in my presentation, I will cover global trends and future perspectives in the financial services sector. I will make reference to the report entitled The Future of Finance that we at Deloitte have published with the World Economic Forum. Judith, if we can move to the next page. Excellent. So as you can see on this page, while many of you might think that the financial services industry is not rapidly changing, I can assure you that change has accelerated over the past decade. The traditional players are being continuously disrupted in all parts of their value chain by new entrants such as fintechs, insurtechs, cryptocurrencies, and neobanks. During our study, we have identified 11 clusters of innovation and have categorized them in different segments of the financial services sector. Those are highlighted in the pie chart that you can see on your screen. Unfortunately, we will not have the time to cover them all today, but I've selected 3 of them, which I would like to do a bit more of a deep dive. I'd like to cover emerging payment rails that you can see here, empowered investors, and insurance disaggregation. This covers various parts of the financial services segment, and hopefully will give you a good perspective. If we can move on to the next page. Yeah, great. So starting with emerging payment rails. In the developed economies, transferring money, or what we call wire transfer, from one individual or corporation has followed the same process for the past 150 years. As you can see from the flow chart on the left-hand side of the page, this process requires a sender to instruct its bank to send a secured message to the receiving bank while wiring the money to a clearinghouse. It's only when the receiving bank confirms receipt of the message to the clearinghouse that the money can be transferred to the receiver. This process is cumbersome. It takes several days. It is costly because it involves several parties and exposes banking credentials to the sender, and hence potentially some fraud risk. If we talk now about in developing economies that are either some of them underbanked or even where customers are unbanked at all, payment processes are run more efficiently than developed economies, as they are unencumbered by legacy systems that I've explained before. And as we can see on the right-hand side of the page, there are 2 main payment rails that emerge: mobile money and peer-to-peer transfer. For example, mobile money refers to a network that supports payment from one user to another via a mobile device. A mobile money service may be launched by any firm, not just a traditional bank or financial institution. Mobile money services has been launched by network operators such as M-Pesa and PayPal. In Kenya, for example, Safaricom has launched a mobile payment based payment and money transfer service. M-Pesa allowing users to deposit money in an account that can be accessed through mobile phones and send balances using SMS. In Switzerland, Twint is a widely used peer-to-peer money transfer application that is circumventing the traditional money transfer processes and is gaining in popularity. Needless to say, these new payment rails lead to increased financial inclusion and empower the consumer. We're going to move on to the next page. And now we're going to cover the empowered investors. Historically, wealth management was reserved to the most wealthy individuals. With the venue of innovation and technology, investment management has been made accessible to mass affluent customers. Three main pillars of innovations have led to democratization of wealth management as it can be seen on this page. Automated investment advice, for example, can take different forms. Some fintechs have developed robo-advisors that create investment portfolios that match investors' risk profiles. These portfolios are rebalanced automatically in light of market movements using artificial intelligence. Some other financial institutions have developed ETFs that allow their clients to invest in certain themes at very low management fees. The allocation of investments in ETFs is rebalanced automatically based on customer preference and market changes. The second theme is more to social trading. Indeed, financial literacy is getting more and more accessible through social media. Online discount brokers not only provide access to a suite of information, but also provide views on the market, trends, and themes to help their customers trade. Some other fintechs, for example, would gather stock performance opinions from professionals and individual investors to create price estimates that would mimic the market reaction, and that is without relying on sell-side analysts, hence avoiding conflicts of interest. Finally, last but not least, retail algorithmic trading provides the infrastructure and knowledge of sophisticated investors and makes them available to retail investors. Hence, the consumers can become what I would call prosumers. If we go to the next page, we're going to talk about insurance disaggregation here. The insurance sector is also subject to disruption. The disruption is taking place in all parts of the value chain in the insurance sector. If we start on the left-hand side of the page with the distribution, there the traditional brokers and agents are facing significant competition from digital channels in their non-life business. Indeed, online aggregators that allowed customers to compare price and purchase insurance products online may displace traditional distribution channels as customer preferences change and more insurance products are being commoditized. For example, I've myself purchased my car insurance online at quite a competitive price. If we move to another part of the value chain, which is the underwriting, the venue of self-driven cars, for example, leveraging sensors are considerably reducing the risk of accidents. This could lead car manufacturers to self-insure their cars that they sell or get into underwriting agreements with insurers and front the selling of the insurance coverage. Last but not least, in the context of low interest rate environments and strong liquidity, there are increasing sources of insurance coverage. A number of new entrants are offering fully collateralized reinsurance coverage through catastrophe bonds. In addition, hedge funds or sovereign wealth funds are setting up reinsurance companies that compete with the traditional insurers. So I will finish my presentation and conclude going on to the next page. We can see here the pie chart that we started with at the beginning of my presentation. And as a reminder, we had identified 11 clusters of innovation. In these 11 clusters of innovations, we have identified 6 main innovation themes that I would like you to take away from this. First, the streamlined infrastructure. I guess more and more banks and insurance companies are choosing cloud solutions instead of on-premise infrastructure. The reason why they're doing this is that it's allowing them to run their technology and infrastructure costs more efficiently while making access to data and information more fluid. For example, many banks and insurance companies have implemented CRMs such as Salesforce in the cloud to help them and their employees to better access customer information, ease client interaction, and provide superior customer service, which benefits not only um, the company themselves, their employees, but also their customers. The second takeaway is, as you can see here, automation of value add activities. There, um, advanced algorithm allow the automation of manual intensive processes and allow banks and insurance companies to focus on value add products and services. The third takeaway is reduced intermediation. The previous speaker did mention that, but it's clear that financial institutions have often acted as intermediaries. Many fintechs today cut the middleman, hence lending to lower costs of service to clients. In the past, when you wanted, for example, to buy shares in a company like Nestle, you would call your banker and he would execute that transaction manually for you. Today, this can be done directly through your mobile phone and some of the apps that we've heard before, such as Robinhood or, for example, Swissquote here in Switzerland. And it's allowing customers to trade directly through trades that are processed through STP, straight through processing. The fourth takeaway is the strategic role of data. Banks and insurance companies are gathering significant amount of data about their customers. With the use of artificial intelligence, the financial services provider are not only better equipped to understand their customer needs, but can also propose products and services that meet their preferences. For example, a bank might want to automatically propose car insurance either directly or indirectly through its insurance partners. The fifth point, which relates to niche and specialized products, we can see that there's been an emergence of specialized institutions that are creating highly targeted products and services that are increasing competition and creating pressure on traditional end-to-end players and forcing them to unbundle. The emergence of specialized ETF or thematic manufacturers products have also made it more cost efficient for customers to invest into the market, which was not only which was not possible before, as traditional players were not offering these low cost investment funds. Last takeaway, last but not least, and probably the most important one, is the customer empowerment. Technology and innovation has given customers the tools, informations, products, and services that were reserved to a selected few. These innovations have also provided more transparency on pricing of products and services and lead to price reduction and more competitiveness. Today, consumers can compare and buy their car or home insurance online. They can directly access to their bank account, get information through social media, invest in large suite of financial products, and do their payments through their mobile phones, and many more. Finally, the winner in all this is the customer, and it improves financial inclusion.